So I started to put together the agenda for today, and then I got interrupted, and so it's not fully put together. It will be though. I will put it together so that you can refer back to it. We're going to start looking at chapter 3 today, where we talk about Social Security taxes. So the last chapter we talked about what wages are. And calculating those wages. So we were talking about in that case gross wages. But as we all know, especially those of us who have worked and received paychecks, we don't actually get our gross wages when we are an employee. We get an amount less than our gross wages. So we've got taxes, certain taxes and other types of deductions that come out of those paychecks. So we're gonna first start talking about Social Security taxes. Now it says Social Security taxes up here. Actually should say FICA taxes. I think your textbook, I'm not sure how they refer to it, but FICA taxes, which consist of two types of taxes. One of those taxes is Social Security taxes. The other one is Medicare taxes. So we're gonna start out today learning a little bit about the history of Social Security. I got a couple of little short videos for you just to give you a little bit of background about what those taxes do, why they are collected, and how they help to, why they were instituted in the first place, and what they provide in terms of benefits. So Social Security, first off, Social Security Tax Act was passed back in 1933 or 35, I can't remember which was again during the Great Depression. So before this time, we didn't really have any social safety nets in this country. We didn't have, if you became disabled or too old to work, once you reached retirement age, there really wasn't, you were kind of at the mercy of your friends and family to help you out if you weren't able to work. So as a result of the Great Depression, we had a change in the way of our thinking in this country and started to implement certain social safety programs. Social Security was a big one. So let's take a look. Everybody can see that. Hopefully, this might be a little too loud. Or maybe not loud enough. Hold on. Best laid plans. Hold on just a second. Let me see if there's another volume.
A variety of social safety networks will gain broad popular support across the nation. So, in 1935, FDR announced the second
We'll start over here.
Social Security is a system where people pay an extra tax on their payrolls and wages to fund government assistance programs and benefits. Today, money from Social Security payments provides pensions to the elderly, the disabled, the unemployed, and their dependents. But Social Security hasn't always existed in America. President Franklin Delano Roosevelt changed all that when he came into office in 1933. FDR was not only tasked with helping Americans survive the Great Depression, but also with figuring out how to improve the lives of people in a rapidly industrializing America. How could America provide its citizens with a social safety net if an economic downturn were to happen again. Upon taking office, he announced the New Deal, a series of programs and projects that aim to provide relief for Americans and institute crucial economic reforms. However, critics complained that these measures were too conservative and temporary in nature. A variety of social safety net proposals gained broad popular support across the nation. So, in 1935, FDR announced the second New Deal, which included the Social Security Act, signed into law on August 15th. Workers pay into pension funds, and once they retire, they receive payments back from that same fund in proportion to their own payroll deductions over the years. Implementing Social Security was not an easy task. To secure the system against attacks from its political enemies in the Republican Party, the Roosevelt administration set up the system as an insurance rather than a welfare program. Every citizen was assigned a Social Security account number. During the remainder of the 20th century, Social Security went through many changes as the Act was amended several times. The 1939 amendments added dependent benefits for the spouse and minor children of a retired worker, and also survivor's benefits to be paid to the family of a covered worker in the event of premature death. In 1950 and 1954, Congress made farm and domestic service workers eligible for Social Security. In 1956, President Dwight D. Eisenhower signed into law amendments to the Social Security Act, which established the Social Security and Disability Insurance Program. Under President Johnson, the amendments of 1965 created Medicare, a basic program of hospital insurance for persons aged 65 and older. In 1983, under Reagan, further amendments made Social Security payouts subject to taxes and began to gradually raise the age of retirement. To this day, Social Security remains a central part of many elderly Americans' lives, allowing them to feel some economic security in their old age. The proportion of retirees to workers on payrolls increases as Americans have longer lifespans, leading to increasing debate over the viability of Social Security, the centerpiece of FDR's New Deal legacy.
Okay, so just kind of a little brief history. I've got another one here too now that this is working. A little bit more detail on the Social Security Act.
Today in Daily Dose, the Social Security Act.
Sorry.
Prior to the Industrial Revolution, elder care and support was generally provided by family and friends within largely agrarian societies, while early in the 17th century, Great Britain established poor laws, which was the first time that a government acknowledged its responsibility to the elderly, the disabled, and the less fortunate of her citizens. After the Pilgrims brought England's poor laws with them into the New World, the first major American public assistance program began during the Civil War, when the federal government began making payments to hundreds of thousands of disabled veterans or their widows and orphans left behind by a veteran's ultimate sacrifice. Beginning in the 1870s, the Industrial Revolution dramatically reshaped the American landscape, enticing many to leave family farms for expanding job opportunities available within industrialized cities. While rising urbanization ushered in improved sanitation, increased life expectancy, and affluence for many Americans, the divide separating the elderly, the disabled, and the less fortunate became much more apparent, while the Great Depression left millions of Americans unemployed, underfed, and desperate for outside help. That all changed when President Franklin D. Roosevelt implemented his New Deal policies intended to offer a hand up to struggling Americans, including the Social Security Act of 1935. Borrowing the concept first employed in Europe, FDR proposed a system in which working-age Americans contributed part of their income into a payroll tax maintained by their employer, setting in motion a perpetual means of compensation to the retired generation of workers who came before them. After a period of heated debate in both houses of Congress, FDR signed the Social Security Act into law on August 14, 1935, which in turn created a retirement pension program, an unemployment insurance program funded by employers, health insurance for people experiencing temporary financial distress, financial aid for widows with children, and financial assistance to disabled individuals. A little more than a week after its rollout, more than 1 million Americans had enrolled in the program, receiving Social Security cards that bore their unique Social Security number, while 4 months later, 26 million Americans now used their Social Security numbers to track their earnings and accrued benefits, making the Social Security Act an ongoing safety net for Americans everywhere. And there you have it.
Oops.
The Social Security Act of 1935. Today in the Daily Dose. If you like learning something new every day, subscribe to the Daily Dose on YouTube.
All right, so just a little bit of a real brief background there. Like I said, I'm still working on the agenda here for today. I will put that up so that you can, just kind of as a reminder of what we cover in class, if you like to go along with it while you're rewatching the video, or if you don't, just to kind of give you a reminder of what we covered. Okay, so the videos talked about the Social Security Act. As I had mentioned, there are actually 2 parts to FICA. First off, let's talk about FICA. Oops. And its sister, SICA. Okay, so for each of these, there are 2 different taxes. We have Social Security tax and Medicare tax. I'll talk about the differences here between FICA and SICA in just a minute. But both of them have both of these components to them, Social Security tax and Medicare tax. Now, Social Security tax is also called, you'll see this in your book, OASDI, which stands for Old Age Survivors and Disability Insurance. Did you catch that part in the video where they call it insurance to make it a little bit more palatable? Sorry, I know this is a little bit low. So OASDI. Medicare tax is also known in your book as HI, health insurance. Okay? So 2 parts to these taxes, but they are combined, and on an employee's paycheck, they'll see the term FICA. Now, Social Security tax and Medicare tax may also be broken up. Oftentimes it is broken up, the amounts on an employee's paycheck, but this is all part of the same act. And this is, so FICA, it's down here, Federal Insurance Contributions Act. SICA is Self-Employment Contributions Act. Both of the taxes that come from FICA collections and from SICA collections go into the same fund, and they go to fund Social Security and Medicare. I know there's a lot of terms there, and there are also quite a few acronyms. You'll become more familiar with them as we go along. FICA pertains to employees. Okay, so this is only for individuals who are employees and for which an employee-employer relationship exists. I'm running out of space, so this is for employees. Anybody guess what SECA is for? What's that? So, non-employees, but what kind of? It's right in the word, in the name. Self-employed individuals. Okay? So, self-employed individuals. Okay? Now, the word employment is used for both of these. This means that these taxes are only collected on income that is considered to be wages. Earned income. We also use the terminology earned income. There are lots of different types of income that people can accumulate, right? The most common is through wages. Somebody gets a job and they get paid. Also, what oftentimes happens, people will be employed on their own as self-employed individuals. That's also considered, though, to be a wage. It's earned income. They are providing some type of service in exchange for that income. But there are other ways that individuals can earn income. They can invest, take some money and invest it in the stock market, put it in into savings bonds. They could put it into a bank and earn interest. All of these types of income are considered unearned income. They're passive. That's passive income. You're not doing anything to receive that income. Your money is what is working, not you in those cases. FICA and SECA apply only to earned income. They do not apply to passive income. So if you've got some money, you put it in the bank, you earn interest on that money. Say you've got $10,000 and the interest rate is 6%, so you earn $600 for the year on that money. That's passive income. You haven't done anything. The money is what's done the work. In that case, that income would not be subject to FICA or SECA. Okay? Again, it's only applied to earned income, where you put the effort in, where the employee or the self-employed individual puts the effort in to earn that income. Okay, so that's all that's the only type of income that these two taxes pertain to. Now, that is the majority of income that's earned in this country, right? Most people, like I said, they go to work or they work for themselves and they earn that income. So the majority of income in this country is going to be subject to FICA or SECA tax. Now, for our purposes, we're really concerned with FICA because as payroll professionals, we're not going to do anything with SECA. And we'll talk about that as we continue through this chapter. But we are concerned with FICA taxes. FICA taxes are what is withheld from employees' paychecks, and we are processing employee paychecks, right? So, let me pull up, I'm sorry, I didn't pull up those slides. Hold on just a second. So in this chapter, what we're going to do is we're going to talk about who is exactly covered under FICA and SECA law. We've already kind of started talking about that. Those services that are considered to be employment. Now, so we identified who is covered by these taxes. We also have to determine what type of compensation are considered to be wages for purposes of this tax. In chapter 2, we talked a little bit about what is considered to be wages and what time that is spent on the job is considered to be compensable time, right? So we're going to go through a very similar list with regard to the FICA and SECA taxes. And we're going to look at the tax rates for both of these taxes. And we're going to do a bunch of calculations. So the employer has collected the taxes from employee paychecks. What do they do then after they have that money? They don't just stuff it in their pockets unless they want to go to jail. They have to then remit the funds to the IRS. So there is a schedule and specific procedures for doing so, and we're going to go through what those procedures are for both reporting the taxes as well as for depositing those funds. So the first thing we're going to look at are the deposits of the funds, the schedule for depositing those funds. This is fun, by the way. This is probably one of the more difficult concepts in the chapter because there are different schedules depending upon how much is collected. Okay, so we're going to go through what those schedules are, and then we're going to talk about this Form 941, which you'll be interested in because you've got homework problems where you have to complete a Form 941. This is the federal tax return that reports the amounts that were withheld. Okay, so employers have to deposit the amounts that were withheld, but then they also have to report the amounts that were withheld. Kind of like as taxpayers, individual taxpayers here, we have amounts that are withheld from our wages every paycheck, and then at the end of the year we've got to fill out a kind of a reconciliation form, and it's called the Form 1040. It's our individual income tax form. So this is sort of the same concept here, where amounts are paid, but then we also have to report the amounts that should have been paid and reconcile those two. If we've underpaid, we have to pay additional. If we've overpaid, we get a refund. So it's the same sort of concept between this procedure and what you may be familiar with the Form 1040 if you've ever filed your own taxes before. All right, so in order to be covered under FICA, and we're just talking about FICA really right now, so the individual has to be an employee. Remember we went through that whole definition of employee versus independent contractor. I'm not going to rehash all of that because we spent quite a bit of time on it. There is a reminder in there of that 6-factor economic reality test to determine whether somebody is an employee or an independent contractor. For FICA, they have to be considered an employee per those same rules that we discussed. Also, the service that the individual renders has to be considered employment. So it has to be the income that they have to earn is, or actually the services that they have to perform have to fall under that definition of employment services. And the compensation that is received for those services has to be considered taxable wages under FICA law. Not all wages are necessarily taxable wages. So you could be an employee, you could be performing employment, but if the wages that you are earning aren't considered taxable wages, then it's not subject to FICA tax. Okay? So all three of those criteria have to be satisfied. Again, I'm not going to go through in detail this difference between independent contractors versus employees. We kind of went through that a lot in chapter 2. A couple of things that I do want to mention, though, for purposes of FICA law, employment would be considered, how do I want to say this? So employees are very specifically defined with regard to an organization. Partners in a partnership, even though they may provide employment services to that partnership are not considered to be employees. A partnership is where two or more people get together and form a business. And they don't choose to be a corporation. So they're automatically a partnership. In a partnership situation, if you're in business with somebody else and it's your own business, you would be considered a partner. Even if you provide services to that business because you're a partner, you would not be considered an employee. So that's one of those exceptions. You do have, I want to mention that because I think you have a homework problem in there that discusses partners in partnerships and whether or not. Louisa, did you have a question?
So under the partnership, you're saying that like under those owners,
Mm-hmm.
those, so people that work for them are employees, or those are?
Yes. So the partnership can have employees,
Okay.
and they would be considered employees for FICA purposes. So that would be considered employment. But the partners themselves, even if they perform the very same duties as an employee. So let's say you and I are in partnership together. We've got we bake cakes, and we form this partnership. And we decide that we need some help with baking cakes, and you and I are baking the cakes, right? But we own this business. So we are considered partners. We're not actually employees. And we decide though that we need some help with that. So we're gonna hire Steve to help us as an employee to help us with baking the cakes. Maybe he's gonna sell them for us or what have you, but he's not a partner. He's an employee of ours. So Steve would be covered under, his wages would be covered under FICA. As partners, our wages would not be covered under FICA. So we don't receive paychecks. We may get payments, but they're not paychecks from the company. We wouldn't be covered under FICA, but we would be considered self-employed. In that case, we would be covered under SECA. And I'll talk a little bit about what the difference there, the big difference is who pays it and how those funds are paid, okay? There are certain occupations that are specifically covered by FICA. So full-time life insurance salespeople, and these are very, very specific. Agent and commission drivers of food and beverages, or handling laundry or dry cleaning. Full-time traveling salespeople, and individuals working at home on products that an employer supplies and are returned to, to furnished specifications. So at-home assembly. I don't know if people do that very much anymore, but that used to be a popular thing to do. So they distinguish these categories of employment are not covered by SECA, they're covered by FICA. Okay? And like I said, you'll see in a minute here why that distinction is important. So some other individuals who may, under certain circumstances, be covered by FICA or may not be covered by FICA. Government employees. If you were an employee of the government before a certain year, and I can't remember when it was a long time ago, government employees didn't used to be covered by FICA. They are now. But if you were an employee before that time, then you would not be covered by FICA. Again, see, they're using OASDI and HI here. Together, that's FICA. Inpatriates. So these are people who are not American citizens, but they're working in the U.S. If there is a specific treaty between the U.S. and the country from which they came, as long as they're not citizens of the U.S., then they may be exempt from FICA. Because what's probably happening is they're subject to their own Social Security tax laws in their country. We're not talking about people who have immigrated to the U.S. They're here temporarily, working. Okay, so certain inpatriates, expatriates. These are Americans, people who would ordinarily be covered by FICA if they were working in the U.S. If they are working overseas and they're paying foreign Social Security taxes, then they are not subject to FICA. So you're not subject to it in two different jurisdictions. Some kids under the age of 18, if they're working for their parents, may be exempt from FICA. Over the age of 18, that is not the case. Household employees. These are people like nannies, gardeners, I don't know, housekeepers, you know, all of that classification. If they make wages of $2,400 or more per year from one employer, then they are subject to FICA taxes. That means if you're a nanny in the summer and you make more than $2,400 during that summer period, your employer, which is the family, is required to follow these rules with regard to FICA taxes. It's handled a little bit differently because it's not really an employer as we usually see it, but they are considered to be an employer, but the taxes are collected a little bit differently and paid differently as well. If they're under your control. So as long as they're not an independent contractor. So for example, if you have a housekeeper that comes in once a week and you pay them, I don't know what it costs now, but I don't have a housekeeper, so say $100 a week. And you have them come in, but they're providing that service to multiple homes. They're self-employed essentially. You're paying them more than that $2,400. You're paying them $5,200 a year, but they're not considered to be an employee because they are providing that service to others as well. Okay, so in that case, that $2,400 would not apply because they're not really under your control. Certain other exemptions, so inmates who earn income, medical interns, student nurses, there are certain specific exceptions to coverage of to FICA coverage. All right, so independent contractors. Again, independent contractors are not subject to FICA, but they would be subject to SECA taxes. So the payer, in this case, they call it employer, but it's really a payer, does not withhold any of these taxes if they're an independent contractor. So if you're an independent contractor and you provide services, let's say you're that housekeeper, and you provide, you know, it's $100 a week and you go once a week, and every month you bill either $400 or $500 depending upon how many weeks you were there during that month. They write the check, it's for the full $400 or $500, right? There's nothing that's been withheld if you're an independent contractor. If you're an employee, however, you would not get that full $400 or $500. You would get an amount less than that because FICA taxes have been withheld. Does that make sense? Ready? Okay. If you have questions along the way, please raise your hand, interrupt me, that's fine. We talked about this as well, this misclassification of employees. You'll see when we start talking about tax rates for FICA taxes and SECA taxes, why it is that a lot of employers would prefer to not be employers. They would prefer to pay their workers as independent contractors. Cuts down on their taxes in order to do that. And so there is an incentive for employers to fudge whether or not somebody's actually an independent contractor versus an employee. There are some pretty stiff penalties though for doing so. And remember, we talked about how it's not up to the employer to classify somebody as an independent contractor or an employee. It's based on the facts and circumstances of how they are providing their services, the employee is providing their services, and who has control over the employment, right? So what usually happens if they are penalized, and if you go out and look on the online, especially under the Department of Labor website or the IRS website, you can find cases that happen all the time. They'll publish cases where employers have been penalized for misclassifying workers as independent contractors when they should have been classified as employees. So the chapter 4 we'll talk about the 1099. So that's pretty much all I want to say about that stuff. All right, before we get into the tax rates for these as well, so we talked about who is covered by FICA taxes. Employees, right? They have 4 covered employment services that are considered to be employment, who are paid wages that are subject to FICA taxes. What are those wages? What are those taxable wages considered to be? So any wages and salaries, just like the ones that we talked about in the last chapter. So same sort of definition. Bonuses and commissions are considered to be taxable wages for purposes of FICA tax. That means that those amounts, so if you received a $1,000 salary and a $200 commission, $1,200 in total is going to be subject to FICA taxes during that pay period, not just the $1,000, but also the additional commission. Cash value of meals and lodging, but only if it's for the employee's convenience. So what exactly does that mean? If you are, let's say you work for a restaurant, and your employer, you're working the lunch shift and you're working the dinner shift, and you really only have like an hour or so in between shifts, and the employer asks you to stay between those 2 times, just in case somebody comes in, but they say you can go ahead and eat while you're here, but we're asking you to stay. Well, that's for the employer's convenience. In that case, the value of that meal would not be considered taxable wages. If, however, let's say you're working the lunch shift and you decide to stick around a little while after your shift, employer hasn't asked you to do it, it's just you decide to grab a meal, well, then it's for the employee's convenience. It's for your own convenience. In that case, the value of that meal would be considered taxable wages for purposes of FICA taxes. Certain non-cash compensation as well is considered to be taxable. And this would be the fair market value of that compensation. So whatever the market would garner for that. Certain gifts over a certain dollar amount. It's usually over like $25, something like that, where those gifts would be considered taxable and added to an employee's wage. So like a gift card, something along those lines. If you got a $50 gift card from Starbucks, that would be considered taxable wages by for purposes of FICA. Stock payments, we talked about this a little bit in the last chapter as well, that is considered to be wages. So if you receive compensation in the form of stock rather than in the form of cash, and when I say cash, I mean money. It can be direct deposited, it can be on a check. I'm not talking about somebody handing you bills. But stock payments would not be in cash, you would receive stock. Instead, that is considered to be taxable wages. You're receiving that instead of cash, right? Other certain fringe benefits. So if you have access to a corporate car, so you're a salesperson and the employer provides you with a vehicle to go out on your sales calls, but you also use that car for personal purposes. So you also use it to go pick your kids up at school. You use it it's essentially your main car. You use it to go to the grocery store. You use it to run all of your errands, to go on vacation. Personal use of that vehicle, the fair market value of that usage would be considered taxable wages and would be subject to FICA taxes. And there are some very specific ways of calculating what that fair market value is. Okay, so it's not like left up to the employer to decide what that fair market value is, but it would just be the personal use of that. Or if you're lucky enough to work for a company that has an airplane that you can use, you use it personally, then that would be considered, that would also be considered taxable wages, the fair market value of that. So some non-cash amounts. Okay, so tips. I think this should be 30. Last chapter was 30, wasn't it? Yeah, so I think that should be 30. Tips, and does your book say look at what your book says, whether it's 20 or 30. The slide might be wrong here. I think it's supposed to be 30. Tips more than $30 in a calendar month. If anybody wants to look that up just to make sure for me, I can enable editing. I'll put that up there until I'm proven wrong. Tips more than $30 in a calendar month are considered to be taxable wages. Now, it creates a little bit of an issue because think about this. The employee is actually the one actually receiving the tips directly, right? They're walking home with the cash in their pocket, or, you know, if it was on a credit card, ideally the employer would have paid them out from that credit card payment. So, there are some special rules with regard to how those amounts are withheld. It is taxable wages, the tips, so there has to be withholding on that. Yeah.
So it is 20.
It is 20? Okay. For some reason I thought that was the same. All right, there we go. So any tips of $20 or more in a calendar month, the employee can either report their tips, the actual tips that they received, on a form, it's called a Form 4070. They fill it out and give it to the employer, and then the employer withholds, adds that to their taxable wages for the following month, and then withholds based on that. Okay? But they do have to have withholding on those tips. There is an additional way that an employer can do this. It's called the ATIP program, Attributed Tip Income Program, and it's a formula based on the employer's total credit card sales, so it's more of an estimation, so that the employee is not giving the exact amount of tips received, but there is an assumed amount of tips received. Employer calculates the FICA on the tips, withholds from their regular paycheck. So that $2.13 an hour, a lot of it gets withheld because the taxes for the tips are being withheld from those paychecks. They have to withhold it on the first paycheck after the tips are reported. So the 4070 has to be, if the employee is using the form 4070, they have to fill that out and give it to the employer by the 10th of the following month. So this is September, right? September's not over yet, but at the end of September, I would list out all of my tips that I received on that form 4070. By the 10th of October, I would give it to my employer. My employer would then add that amount to the total wages that I received, and then would withhold FICA taxes based on how much they paid me and how much I had reported in tips. So it's entirely possible that employees would receive nothing in a paycheck because all of it's been withheld, but they received the tips, right? They received the prior month, they received those tips in cash. So those are, like I said, there's a couple of different ways. This ATIP, like I said, it's an estimation. So it's based on a formula, based on the employees or employer's credit card sales. All right, certain wages that are specifically exempt. We already talked about this, meals and lodging for the employer's convenience. Sick pay, I'm not talking about like if you took a sick day, I'm talking about disability insurance, like if you were on disability. That is exempt from FICA taxes. If an employee is a reservist or in the military and they're activated for more than 30 days, and the employee's salary, there's a difference between those two and it's made up by the employer, those would be exempt wages, because essentially they're not really working for those amounts, right? They are, that's not necessarily earned income, but it's an amount that the employer is making up. Employer contributions to retirement plans. So if the employer, we usually think of 401ks in this situation. A 401k is a type of retirement plan where, generally speaking, the employer will contribute a certain amount based on a percentage of income, and the employee will also contribute a certain amount. The amount that the employer contributes is not considered to be taxable income for FICA tax purposes. Employer-provided education assistance up to $5,250 a year. So if you're lucky enough to have an employer that will help pay for your education, higher education here, they can pay up to $5,250 a year, and it's not considered taxable income to you, which is a great deal, right? Because otherwise, you would have to take that $5,250 out of your funds, and it would be coming out of money that was taxable when you earned it, right? So this way, it exempts that amount from taxation. Again, it's only up to, if it's non-job related, it's up to $5,250. There are a lot of employers out there that will help provide tuition assistance, maybe, to help you get your bachelor's degree or your master's degree. They may want you to stick around a while after obtaining that, but there are a lot of employers out there that will do that. Also, any job-related educational expenses. So, for example, as a CPA, I have to have continuing education every year. I have to have 40 hours of continuing education every year. That's not free. I have to pay for those 40 hours, and let me tell you, sometimes they're not cheap to do that. If my employer pays for it and it's related to my job, then that is not considered to be taxable income to me. Okay. So that would be job-related educational expenses, but then also non-job related up to $5,250. So there's a limit if it's not job-related. Okay. Questions so far? All right. Let's get into some calculations, shall we? All right. So we've got all this down, all these acronyms and everything, FICA versus SECA. Let's talk about the tax rates for both of these. More acronyms. Right now we're just talking about FICA. OASDI, otherwise known as Social Security, one type of tax, and then Medicare, also known as health insurance, as your book puts it. I will tell you, I never referred to it as HI before I started teaching this class. It was a textbook. Like in working, it was always just Medicare. And my abbreviation was never HI, it was MC. So if you see me write MC, what I'm talking about is Medicare, okay? So the tax rates, 6.2% of taxable wages for Social Security, 1.45% for Medicare. But that's just half of it. This stands for employer, this stands for employee. For FICA tax, the employee and the employer share the taxes equally. Each pays 6.2% for Social Security tax. Each pays 1.45% for Medicare tax. So the total tax rate, 12.4%, 2.9%, 15.3%. It's a fairly big chunk of change. We're not even talking about income taxes yet. This is just FICA taxes. So, like I said, it is shared equally between the employer and the employee. So and it's based on the taxable wages. So if we have an employee that has $100,000 of taxable wages, I don't have any space left here. Just see if I can. No, I'll do it right in between. $100,000 of taxable wages. That means that the employee is going to pay $6,200 in Social Security tax, 6.2% of $100,000. The employer is also going to pay 6.2%, $6,200 in Social Security taxes. So essentially, the employer has now paid $106,200 for that employee, for a total of $12,400. Right, so if we got the 100,000, so this is 6,200 plus 6,200, 12,400 in Social Security taxes. Then they've also got Medicare taxes on top of that. So the employer would pay $1,450 in Medicare taxes. Employee would pay $1,450 in Medicare taxes, for a total of $2,900. Add those two together, total of $15,300 of Social Security and Medicare taxes have been paid on that $100,000 of taxable wages for Social Security and Medicare taxes. I just repeat myself. $15,300 in total. Okay, so that's why it's important for us to determine how much our taxable wages are, because that's what we're going to base our tax on. How do we calculate the tax? Now remember, this amount from the employee would be withheld from their paycheck. Not a single paycheck. This is over the course of a year, right? So whatever they get every paycheck, 6.2% for Social Security taxes would be withheld, 1.45% for Medicare taxes would be withheld. But for the employer, they also have to set aside every paycheck enough to cover their portion of these taxes. This is where employers get themselves into trouble. Sometimes employers will not set aside that money that they owe. And there are some very stiff penalties when they underpay. And I understand, it's not understandable, but it is understandable. From a practical standpoint, you've got this money sitting there. If you need funds for your operations, it's very tempting to then pull that money out and say, well, I'm just borrowing it so that we can, pay the rent for this month or pay the car lease for this month. But you get into trouble by doing that, because those funds on the employer portion and those funds on the employee portion, they don't belong to the employer. Right? They are not, the employer is essentially in trust. They're acting as a trustee of those funds, and then they have to remit them in the future to the IRS. Okay, so this is FICA tax. Questions? We'll go through more of this, by the way. Questions about the tax rates. Now there are some nuances as well that we will go through. And I guess I might as well mention it here because it says it here on the slide. So the Social Security portion is considered to be what we call a regressive tax. Most of our taxes, our income taxes, our federal income taxes in this country are progressive. That means the more you make, the more they take. As you earn more money, the tax rate goes up, right? So somebody making $100,000 is going to be in what we call a marginal tax bracket that's higher than somebody who's making $10,000. Okay, as you increase in income, the tax rate on the additional income goes up. So that's called a progressive tax rate, tax system. We also have what's called a proportional tax system. Sales tax is a good example of that. The tax rate is the same, regardless. So if you buy something that's $10 and is subject to sales tax of 7%, that 7% applies if you buy something for $100,000. right? It doesn't matter what the amount is. The tax rate, we also know that as a flat tax. There is also a tax system called a regressive tax system. That means that the more income you make, the less you actually pay in taxes. Social Security is one of those types of taxes. It has what's called a tax base. You only, and the employer as well, only pays this 6.2%, 6.2, 12.4% on the first $147,000. Once you make $147,001, the tax rate on that additional dollar is 0, as far as Social Security is concerned. There's no more Social Security tax. Okay, and we'll go through some examples and calculations of how all of that works. So this means that, and this is for 2022, 2023, it changes every year. Let me see if I can pull up 2023 wage base. It's 160,200. So that was a big jump between 147 and 160,000. So in 2023, this year, you have to make $160,200 in taxable wages before you can start to enjoy that 0% Social Security tax rate. Let's see what's going to be in 2024. They've determined it yet. 167.7. So it'll go up to 167. It is my hope for all of you and for me that someday we all reach the point where we don't have to pay. We start earning enough money so that we don't have to pay the additional Social Security tax. But the more you make with Social Security, the less they take. That is regressive taxation. Okay? Like I said, we'll go ahead and do some calculations on that. This calculates out to $9,114 a year. That would be for each, the employee and the employer. So together, $18,228 maximum Social Security tax. For Medicare, this is a flat tax. It's 1.45% on the first dollar, on the $873 millionth dollar. It's still the same rate, 1.45% for the employee, 1.45% for the employer. So that is a flat tax. This is a regressive tax. Okay. For purposes of the homework, don't pay attention to 2023 or 2024 numbers. Use this number here, okay? Because that's what your homework uses. Questions about that? Okay, before we calculate this, I'm going to talk a little bit about SECA because I talked about FICA here. Now, even though you don't, as a payroll professional, you don't have to calculate SECA taxes, that is the responsibility of the self-employed individual. They are responsible for paying their own taxes, their own income taxes, their own Social Security and Medicare taxes, right? But it's good to know the difference between the two. So for SECA taxes, let's erase this here. Remember, a self-employed individual is both employer and employee. So they get the privilege of paying both halves. So if you're a self-employed individual, you're paying the whole 15.3%. So there is still a half and a half, but you're the employee and the employer at the same time when you're self-employed. I had tons of clients who decided that they were going to go into business for themselves and they were not aware of this. And it was quite shocking to them because that is a big chunk of money to all of a sudden have to come up with. And if you hadn't planned ahead and set that money aside, to have to come up with that at the end of the year is painful. Very painful. Okay? So the wage base is the same as well for SECA tax. Okay? So once you reach that 147,000, then for SECA you no longer have to pay on the amount over 147. You no longer have to pay the 12.4%. You still have to pay the 12.4% on any amount up to 147. That still applies. It's just once you get to that point, any additional money is no longer subject to the Social Security tax. Okay? Questions about that? That make sense? Now's your chance. Well, you have other chances too, but. All right. The same thing, so for SECA tax, same thing for Medicare. It's 1.45%, starts at the first dollar up to infinity. 1.45%. Now, this wage base, I will tell you, the wage base applies to the individual. Each individual for the year from January to December, and it's always January 1st to December 31st. Each individual has this $147,000 wage base. If you're married, each spouse has a $147,000 wage base. If you have multiple jobs though, think about this. If you have, maybe you started a job, you're a high earner, you started a job first half of the year, you worked from January 1st to June 30th, and you made $100,000. And then you got a second job, another job, you changed jobs during the year, and the last half of the year, you also earned $100,000. Well, now you earn $200,000 during the year. You're above that $147,000 wage base. You will not have, the income above 147 in total will not be subject to Social Security tax. Now, something kind of interesting happens though, because that second employer has no idea how much you made. They shouldn't have any idea how much you made at the previous employer, so they will continue to withhold Social Security tax. Even though, in total, over the course of the year, you're over that 147. They'll continue to withhold. What happens is when the taxpayer files their tax return, that will be taken into account and they'll get a refund of additional Social Security taxes that were paid. The employer will not get a refund of it for their half because they've paid more than half as well. But the employee will get a refund on that half of the wage base. Now, it's also possible, and we're going to go through some examples, for an individual to have, and it's quite common, you're an employee somewhere, and then you got a side hustle. So you're also self-employed. Well, now you've got two different tax regimes that you're dealing with. You've got FICA taxes and you've got SECA taxes. That 147 again stays the same, does not change. So if you made $100,000 a year at your day job as an employee, and then you made $50,000 of taxable wages as a self-employed individual, well, only $47,000 of that $50,000 is going to be subject to SECA tax. Does that make sense? I know I'm talking through it. We are going to go through some examples as well, some calculations on that. What are we doing here on time? All right. So, in these examples, they want you to calculate it based upon a per pay, how much is withheld for each pay. So we already know, look, Tamara, so you're gonna have to do a couple of calculations here, and you do have homework problems like this. Tamara earns $150,000 a year. Is she above she's above the wage base, right? But there's a point at which she's going to reach that wage base. On January 1st, she hasn't reached that wage base, right? It's not until the end of the year when she's going to start to reach that wage base. So there is going to be a pay period during which some of her payroll is subject to Social Security tax and some of it isn't. And you have problems like this. You also have problems where you're supposed to determine during which payroll they reach that maximum. Okay, so let's take a look at this one here. So she gets $150,000 a year. She's paid semi-monthly. So how many pay periods does she have a year? semi-monthly. Semi means half. 24, right. She got 24 pays per year. All right. We had a meeting about facilities. We were all allowed to chime in on what we would like to see as far as changes in facilities and stuff, aside from getting rid of the cinder block. I said whiteboards everywhere, all over the place. Sounds like they're whiteboards. Okay, so what we have to do, so she's paid semi-monthly on the 15th and the 30th of the month. The question is, what is her FICA for the December 30th payroll? So this is the last payroll of the year. In order to determine that, the first thing we have to do is figure out what she's made so far. All right? So she's been paid 23 pays so far, up to this point. We don't want to include this pay period quite yet. We want to see how much she's made up to this point. So 150,000, and we're going to divide it by 24. We get, what is it, 6250 per pay. She has worked, she's been paid 23 times during the year, right? And these again are her taxable wages. We're going to go through some problems where you have to figure out, well, how much is her taxable wages? Like maybe it's this is her gross wages, but she's got some amounts that reduce her taxable wages. But for now, we're going to assume we know what her taxable wages are. So $6,250 per pay. She's had 23 pay periods. Right? I know they've done the calculation here, but just because I like to use the calculator. $143,750. Okay, so up until December 15th, right? So this is through 15. She's made $143,750. So she hasn't exceeded that 147 yet. But wait a minute. With this next pay period, let's see how much she would be up to. This would bring her up to 150. That brings her over. That means that some of this 6250 is going to be subject to Social Security tax and some of it isn't. All of it's going to be subject to Medicare tax. Okay, that's not a problem. Medicare is easy. But, get that out of the way. So there are a couple of ways to do this. I can't remember how your book does it. Let me see here. Okay, so let's go with we'll do the way that they do it. I don't always do it this way myself, but we'll do it this way. So how much is going to be taxed? So this would be the December 15th. What you can do is take the taxable wage base, 147, for Social Security, base 147, subtract prior period year-to-date wages, taxable wages here. So subtract that, we've got 6,3,250. Is that right? 3,250 is the amount that's remaining that is taxable in this pay period. Sorry, no, that's low, sorry. I'll try to start up higher in the next calculation. I think I've got hold on just a second. got some steps up here listed to calculate current period FICA. So calculate the prior period year-to-date salary up to the current pay, not including the current pay, which is what we did here, $143,750. Take the OASDI wage base minus the prior period year-to-date salary, which is what we did here. So wage base minus the salary. If the result is 0 or negative, then there is no OASDI tax during this pay period. And then you can skip to step 4. If the result is greater than 0, which we had, $3,250, calculate the current period OASDI tax liability, multiply the OASD tax rate by the smaller of either the result in step 2, which is this, or the current period total wages, which would be, so the smaller of those two. I'll show you an example. We'll use this and I'll show you how this changes, how the result changes if we're at a higher year-to-date amount or a lower year-to-date amount. So let's just say that, well, don't worry about this part right here. We'll start here. Let's say that through December 15th, she had made, I'll put it up higher too. So year-to-date prior period was $150,000. Okay. So taking these steps, OASDI wage base minus the prior period year-to-date. Well, 147 minus 150 gives us a negative number, right? Negative 3,000. If the result is 0 or negative, there is no OASDI tax. And that makes sense, right? Because she's already exceeded the wage base. At this point, the prior period, she exceeded the wage base. So none of her wages this period would be taxable. Okay? Let's look at it. Let's say, I guess I can keep the 147 up there. Let's say that her prior period year-to-date was $127,000, and she makes, I don't know, $5,000 per pay. I know that doesn't add up right, but just for simplification. So the question is, how much of this $5,000 is going to be subject to OASDI tax? Remember, we're just talking about OASDI, Social Security, Medicare tax. It's all going to be taxable. So using these steps, calculate the OASDI wage base minus the prior period year-to-date. Which gets us $20,000. Right? If the result is 0 or negative, there's no OASDI. If the result is greater than 0, continue to step 3. Calculate the current period. Multiply the OASDI tax rate by the smaller of this or this. We're going to use that. So that means all of her wages during this period would be taxable. Okay? Go through step by step. It will get you to where you need to go. Okay? When you're calculating its current period FICA tax. Use this. It's under, and this is under Chapter 3, Calculations and Whiteboard Examples. I've got another example here we'll go through on, today's Tuesday, on Thursday, when we have that combination between Social Security and Medicare. Now, you're not done yet. So we figured out in this example how much is taxable, right? The $3,250. We're going back to our original example now. So $3,250 is taxable for Social Security purposes. Of her $6,250 salary, $3,250 is subject to Social Security tax, but the entire $6,250 is subject to Medicare tax. So to figure out how much, we're going to multiply this by 6.2%. We're going to multiply this by 1.45%. So 3250, 9.062, 20150. Remember, the employer has a portion and the employee has a portion, which is going to be equal. Whoops, 20150. For Medicare tax, 6250 times 0.0145, 9063. And the employee portion, 9063. So in total, no, they did it here. So 292.13, 292.13. So the total amount that is going to have to be paid for Tamara's salary, her wages, during the December 30th pay period is going to be the sum of those two amounts. She is going to pay half of it. The employer is going to pay the other half of it. Okay? To show you how this regressive, just real quick, show you how the regressive tax works. On her December 15th pay, so this was 12/30. On December 15th, all of the amount, 6250 times 6.2% and 6250 times 1.45%. So on the December 15th pay, she would have paid 9063, 9063, and 6250 times 6.2%. 387.50. $478.13 would have been withheld from her pay, and the employer would have had to pay, and the same thing over here. So her taxes went down between those two pay periods. Got it? Okay, go ahead and go. We will pick up on this on Thursday. Start looking at the homework, because then you can come with questions and you will have had a chance to kind of think through it a bit.